Bitcoin is the best AI investment for 2026 and beyond. And we are going to get into why, because we live in the most technologically productive moment in human history. We know that artificial intelligence, automation, software, and global networks are driving costs towards zero across almost every single industry. Every industry that touches computation, logistics, and coordination, we can produce more with fewer people, less time, and less physical input than ever before. And in a functioning market, we know that this would be obvious in everyday life. Prices would be steadily falling, savings would grow stronger over time, and each hour of work would buy more freedom and not less. Yet we all know that the lived experience that we're going through is the opposite. Despite exponential innovation with technology, life keeps getting more expensive. Assets continue to drift further out of reach for the working man. We know that wages struggle to keep up, and people are told that this is simply how modern economies work. But purchasing power continues to erode. That means that something must be misaligned. When abundance increases but affordability disappears, the system translating progress into value is failing. And this presentation today begins with a simple question that most people never ask. If technology is advancing faster than ever, why does the future feel financially smaller? And the answer is not found in innovation, the answer is found in the money. To understand what has gone wrong, we need to start with a basic economic truth that predates modern finance, and we're going to give a quick shout out to Jeff Booth and his book, The Price of Tomorrow, because he talks about the natural state of a free market being deflation. In a genuinely free market, genuinely free meaning the money supply is not manipulated, the default outcome of progress, of technological human productivity gains is deflation. It's very simple. When technology improves, that means it reduces the amount of human labor, human energy, and capital required to produce goods and services. So the efficiency rises in the economy, and then the output expands, and then the prices compress because these goods and services are easier to acquire, easier to produce. And this is not some theory, this is very observable across history. Because we know that computing power that once filled buildings now fits in your pocket, communication that once cost dollars per minute now costs almost nothing, and logistics systems that once required armies of people are now coordinated by software. And we've seen throughout history that every technological breakthrough delivered the same result, which was more capability at a lower cost. So in a healthy monetary environment, those savings flow outward. They show up as lower prices, stronger purchasing power, and rising standards of living. So deflation in this context doesn't mean economic distress. It means progress that is made visible. It means society is capturing the gains of innovation rather than losing them. It means time and effort are rewarded with increasing returns. So when prices fall because productivity rises, people work less to live better. And that's what real economic advancement is supposed to look like. And if that feels unfamiliar, that's because we no longer live inside of a system that is designed to allow that. So if deflation is the natural outcome of technological progress, the next question becomes unavoidable entirely. The question is, why does it not happen? And the answer lies in the structure of the monetary system itself. Modern fiat systems expand the money supply continuously, regardless of whether real productivity has actually increased. We know that new units of the currency are created faster than the economy's ability to absorb them through genuine output. And this expansion, we know, does not affect everyone equally. New money enters the system through these financial institutions, the governments out there, and the asset markets first. So prices in those sectors, they adjust early, and we know that wages and savings, those adjust last. So by the time the purchasing power reaches most people in society, it has already been diluted, and the result is subtle, but it is profound. Technological gains that should lower prices for all of us, they are offset by the monetary expansion of fiat currency. We know that efficiency continues to improve, but the measuring unit continues to deteriorate. We're having all of this progress occurring with the technology, yet the benefits fail to accumulate where the human effort is actually spent and this creates the illusion that innovation no longer works. Because in reality, innovation is working perfectly. It is the monetary layer translating that progress into value. That is what is broken. When money expands faster than productivity, deflation becomes totally impossible. The abundance that is created, that is converted into inflation, and then time quietly loses purchasing power, and that is the trade-off that is built into the system that we are living in. And then when we talk about AI makes this distortion that we're talking about totally explode. It's not introducing some new economic problem. What it's doing is that it is exposing the existing problem at a much higher speed, because we know that AI dramatically increases output without requiring a proportional increase in human labor. If you have used AI, you know that the tasks that once required teams of people, lots more time, lots more coordination, they can now be executed instantly, repeatedly at near zero marginal cost. And in a functioning system, this would accelerate deflation, prices would start to fall faster, purchasing power would rise more quickly, and human time would actually become more valuable. But instead, the opposite is occurring. As this AI-driven productivity continues to explode, the monetary system is going to expand right alongside of it, and the efficiency gains are then absorbed by asset inflation rather than reflected in everyday affordability. This means that capital will continue to scale effortlessly, but labor does not. And this is what is going to create a widening gap between what technology makes possible and what people actually experience. The output is going to rise, yet the living standards feel compressed. Work becomes more competitive while all of our savings grow weaker. So AI is going to continue to redistribute this value through the monetary system that's already in place. So when the measuring unit of that monetary system is unstable, that means that faster progress amplifies distortion rather than prosperity that we all deserve. And the more productive the economy becomes, the more visible the flaw in the money that measures it, and AI accelerates the reveal of this. And at this point, you realize the necessity for Bitcoin because something becomes very clear. We are not living inside of a single economic system. There are two monetary systems existing in parallel, measuring value in fundamentally different ways. The first is the familiar fiat system, the supply expanding, the issuance being centralized with a central bank, value leaking over time through dilution of the currency, and saving becoming a liability rather than a virtue amongst the populace. This fiat system, it absorbs the technological progress by spreading it unevenly amongst the people. Productivity will continue to increase absolutely, but the purchasing power does not follow it evenly through society. And then alongside it, an amazing second system operates quietly that you can access whenever you want to. Bitcoin has the monetary environment with a fixed supply and no issuing authority. There's no political discretion or dilution of the currency. There is no requirement for trust in an intermediary. And within this system, all of those productivity gains, those behave very differently, and this is the important part of today's presentation. When technology reduces the costs, prices fall in Bitcoin terms. Everything gets cheaper when Bitcoin is your money. When efficiency, because of increased human output because of AI, when that efficiency rises, the stored value does not weaken to compensate for it. So this is a choice of measurement. One system continually redefines the unit and the other one does not. And when the unit remains stable, that means that the progress finally becomes visible. The most important distinction between these two systems is what happens to progress after it occurs. In an inflationary system, the efficiency gains are neutralized. The costs, they might fall temporarily, but monetary expansion is the thing that is absorbing all of the benefits. We know that the progress is real, yet the rewards disperse before they can actually be stored, but in a fixed supply system, that dynamic just totally changes. When productivity improves, prices fall relative to the unit of account. Savings strengthen instead of weaken, and economic value accumulates rather than escaping. Bitcoin is not a creator of the productivity. Bitcoin is the productivity absorber of all of the advancements of human technology. Every improvement in technology, each reduction in cost, each increase in output quietly increases purchasing power for those measuring value within this system. The time that is worked today retains its claim on tomorrow's abundance. This shifts the relationship between labor, capital, and the future. Work starts to become a way to capture progress rather than race against progress. Saving then becomes a method of participation and innovation, not resistance to inflation. And in this environment with Bitcoin, technological advancement finally benefits the individual directly. The reason why Bitcoin matters so much in the AI age is very simple. Technology is moving faster than any monetary system in history was designed to handle. We know that AI compresses decades of productivity gains into years, soon into months, and as this innovation continues to accelerate, the weaknesses of expandable money compound. The faster the economy improves, the faster the purchasing power erodes, abundance increases, yet value becomes harder to preserve. And at the same time, nearly everything is becoming easier to replicate. Code can be copied, content can be generated instantly, labor can be automated by robots. So in this new world where the production is increasingly infinite, scarcity becomes the defining economic property. Bitcoin is introducing engineered scarcity into an environment defined by exponential productivity, a unit of account that does not change as everything else does. And that means that Bitcoin is allowing individuals to step into a monetary system where progress compounds rather than evaporates, where time work today maintains its claim on a more productive future. In the AI age, the most valuable asset is not speed, it is a stable reference point, and Bitcoin provides that reference. And if you want to be in position before this shift fully happens, and you want to do it the right way, Swan Private is for you. Swan Private works with high net worth families, individuals, and companies, building generational Bitcoin positions securely, strategically, and with real macro insight. We help clients understand the macro forces that are driving this transition and how to own real Bitcoin and not paper IOUs. Because the goal isn't to trade the next crash or the incoming AI transformation of society, it is to survive and thrive through all of this massive change. Visit swan.com/no-second-best to learn more, and like and subscribe to Swan. We are bringing you daily Bitcoin insight during the greatest wealth transfer in the history of humanity, and we appreciate you being here with us every single step of the way. My name is Adam Livingston. I am the Bitcoin Wizard. I hope you enjoyed this content. Have a terrific day and a very happy new year. Class dismissed.